right, so we're diving into this Motley Fool article today, and it's called Want Decades of Passive Income? Buy this ETF and hold it forever.
Okay.
Pretty bold claim, right?
Yeah.
It's all about dividend ETFs, specifically ones that focus on companies with a history of growing their dividends.
Right.
So I'm really curious to kind of dig into this with you and see if it lives up to the hype.
Yeah.
Is this really a path to decades of passive income? I mean, who wouldn't want that, right?
Yeah, it's a hot topic these days.
Yeah.
A lot of people looking for reliable passive income streams, especially as retirement gets closer.
Exactly. That's something that's always on my mind, and I'm sure a lot of our listeners are thinking about that too.
For sure.
Let's start with the basics, I guess. The article highlights some historical data on dividend-paying stocks, and it seems like they've consistently outperformed non-payers.
Yeah, that's right. They have. The data from 1973 to 2023 shows that, pretty clearly, dividend-paying stocks on average delivered annual returns of 10.19%.
Wow.
While non-payers lagged way behind at 4.27%. Even the S&P 500, that benchmark everyone uses, only averaged 7.72% over the same period.
Those are some pretty impressive numbers.
Yeah.
It really does seem like focusing on dividend growth could be a smart move for long-term investors.
Right. Definitely for the long haul.
But how do dividend ETFs fit into this?
Well, think of them as like a convenient package deal. You get to tap into the power of dividends without having to pick and choose individual stocks.
Okay.
It's like a basket of dividend-paying companies all in one place.
Gotcha.
So you're diversifying your investments across different sectors, potentially reducing your risk.
Makes sense. The article looks at 5 specific dividend ETFs. The SPDR Portfolio S&P 500, High Dividend ETF,
Okay.
the Schwab U.S. Dividend Equity ETF, the iShares Core Dividend Growth ETF,
Right.
and 2 from Vanguard, the Dividend Appreciation ETF, and the S&P 500 ETF,
Yeah.
which seems to be there for comparison.
Yeah, it's like the baseline,
Yeah, exactly. So one thing that stood out to me was this kind of tension the article highlights between high dividend yield and overall fund performance. Some investors might be tempted to just chase the highest yields, but
tempting.
it's not always the best strategy, right?
It's not the whole picture. A high yield could actually be a warning sign.
Oh, really?
Yeah, it could mean a company is struggling financially. Their stock price might be down, leading to a temporarily high yield. But that might not last.
Okay.
What you really want is a company with consistently growing dividends that shows they're healthy and committed to sharing profits with their shareholders.
So it's more about sustainability and long-term growth potential rather than just chasing those flashy high yields.
Exactly. Growth is key.
And the article ultimately picks the Vanguard Dividend Appreciation ETF, or VIG, as the winner for long-term passive income. So what makes VIG so special?
Well, it tracks the S&P U.S. Growers Index, which, as the name suggests, focuses on companies with a proven track record of increasing their dividends for at least 10 years straight.
Wow, 10 years.
Yeah, it's a pretty good sign of stability and growth potential.
That's a significant period. Yeah, that means these companies have gone through different economic ups and downs and still managed to prioritize dividend growth.
Exactly. They've weathered the storms.
But what about companies with those super high yields? Does VIG include those?
Actually, no. It specifically avoids stocks with very high yields.
Oh, interesting.
It's all about finding that balance between sustainable growth and consistent dividend increases.
This is more of a slow and steady wins the race kind of approach.
Yeah, you could say that plus VIG has a low expense ratio of 0.06%, which is great for investors who are mindful of costs.
That's definitely a plus. So let's take a look inside VIG. The article lists its top 10 holdings as of November 30th, 2024. And there are some big names in there. Apple, Microsoft, JP Morgan Chase, Home Depot, Costco.
Yeah, the blue chips.
Yeah, exactly. These are all companies that most people recognize and probably interact with on a daily basis.
It definitely gives you a sense of confidence.
Yeah, for sure. But here's the thing that initially made me go, The article mentions that VIG's current yield is only 1.69%.
Right.
That doesn't exactly scream passive income bonanza,
Yeah, at first glance, it might seem a little underwhelming.
Yeah, especially for people who are looking for immediate cash flow.
I mean, if you invested $5,000, you'd only be looking at about $84.50 in annual dividends initially.
Right. Not exactly life-changing money.
No, but the key here is that the real power of VIG isn't in its starting yield, it's in its potential for growth. That's where the hold it forever idea comes in.
Okay, so it's all about the long game.
Exactly. We need to shift our focus from yield to growth, and that's what VIG does so well.
And how exactly does it do that?
Well, the article says that VIG's dividend has almost quadrupled over the past 15 years with an average annual growth rate of 9%.
Wow, a four-fold increase in dividends in 15 years. That's pretty remarkable.
It is. So even though the starting yield might seem small, the potential for future income is huge.
I like it. It's like planting a seed that might not look like much at first, but with time and care, it can grow into a big, strong tree, providing shade and comfort for years to come.
A perfect analogy. It's all about patience and long-term thinking, dividend investing.
We're not talking about get-rich-quick schemes here. We're talking about building wealth over time through consistent growth.
That's the idea. And we haven't even talked about share price appreciation yet. As the companies in VIG grow and become more profitable, their stock prices should go up too.
So it's like a double whammy of growth, both in dividends and share price.
Exactly. You're getting growth on both ends.
Okay, so VIG offers potential for current income and future growth. No one of the articles suggests holding it forever, but are there any downsides or risks with this approach?
Well, you're right to be cautious. No investment is completely risk-free.
Right.
While VIG focuses on dividend growers, which does offer some stability, it's still connected to the overall market.
Meaning?
If the market takes a big hit, VIG's value could go down, and some companies might even struggle to keep up their dividend growth.
So even with a dividend-focused strategy, diversification is still important.
Absolutely. You never want to put all your eggs in one basket.
So spreading investments across multiple dividend ETFs, maybe some that focus on different types of companies or markets, could help manage that risk.
Exactly. It's all about building a resilient portfolio that can handle different economic situations.
That makes a lot of sense. And speaking of different approaches, what about actively managed dividend funds? Are they ever worth considering over passively managed ETFs like VIG?
It's a good question. Actively managed funds do charge higher fees,
Right.
but some investors believe they can outperform the market and make up for those fees.
Okay.
But consistently beating the market is really hard even for professionals.
Yeah, I can imagine.
And historically passively managed index tracking ETFs like VIG tend to do better in the long run.
So it's a trade-off.
Yeah.
You have to weigh the potential benefits of active management against the extra costs.
Right, and figure out what fits your investment style and goals.
It seems like just focusing on yield or chasing the latest hot dividend ETF can lead to disappointment.
Definitely. It's about finding the right balance between growth stability and diversification for your own financial journey.
That's a great way to put it. We've covered a lot of ground here, from the history of dividend stocks to the details of dividend ETFs and the importance of diversification.
Yeah, it's been a good overview.
So for our listeners, we'll pause here for now. Take some time to think about what we've discussed and how these principles of dividend investing might apply to your own portfolio.
And when you're ready, join us for part 2 of this deep dive, where we'll explore international dividend ETFs and all the potential they offer.
Awesome. Until then, keep those dividend engines running.
Welcome back. It's great to be continuing our exploration of dividend investing.
Yeah, I'm excited to dig deeper.
And today we're going to be shifting our focus to the international scene.
Yeah, in part 1, we talked about how U.S. dividend ETFs, especially ones like VIG, that focus on dividend growth, can be a really good way to build passive income. But you mentioned that diversifying beyond the U.S. market could unlock even more potential.
Exactly.
Let's talk about that. What are some of the key things to consider when looking at international dividend ETFs?
Well, one of the first things to think about is the different types of international dividend ETFs that are out there.
Okay.
You've got some that focus broadly on developed markets like Europe, Japan, Australia, and then you've got others that target emerging markets like China, India, Brazil.
Okay.
And of course, you've got ETFs that offer a mix of both.
So it really comes down to aligning our investment strategy with our risk tolerance and our growth expectations.
Right, exactly. Developed markets tend to offer more stability,
Right.
while emerging markets have the potential for higher growth, but also come with more risk.
So it's a trade-off, as with most things in investing.
Always a trade-off.
And another thing we have to think about is currency fluctuations.
Oh yeah, that's a big one. When you invest in international ETFs, your returns are affected by both the performance of the companies and the changes in exchange rates between the U.S. dollar and the currencies of those companies.
So even if the companies themselves are doing well, if the U.S. dollar gets stronger, our returns could be lower.
That's right. And the opposite is true, too. If the dollar weakens, our returns could get a boost.
It seems like there's an extra layer of complexity with international ETFs compared to just sticking with U.S. ones.
It's true. There are more moving parts. But that doesn't mean international ETFs aren't worth considering.
So how do we go about evaluating and selecting these international dividend ETFs? What should we be looking for?
Well, a lot of the same principles we talked about before still apply.
Okay.
You want ETFs with a good track record of dividend growth, a diversified portfolio of companies, and reasonable expense ratios.
That makes sense. But what about the underlying index or investment strategy? Is it important to understand how the ETF chooses its holdings?
Absolutely. Some international dividend ETFs track broad market indices, while others focus on specific sectors or investment themes. It's really important to understand the ETF's methodology and make sure it aligns with your goals.
Okay, this is starting to feel a bit overwhelming.
Yay.
There's so much to consider: geography, risk tolerance, currency fluctuations, index construction. How do we make sense of it all and choose the right ETFs for our own portfolios?
I get it. It can seem like a lot, but don't let it discourage you. Start by getting clear on your investment objectives.
Okay.
What are you looking for? Primarily income growth or a combination of both? And how much risk are you comfortable taking?
Okay, so first, define our goals and risk tolerance.
Exactly. Then you can narrow down your options based on the type of international exposure you want.
Developed markets, emerging markets, or a global mix.
Right. And from there, you can start looking at specific ETFs, examining their track records, portfolio composition, expense ratios, and investment strategies.
So it's all about taking a systematic approach, breaking down the decision into smaller steps, and focusing on ETFs that meet our specific needs and objectives.
Exactly. And remember, there are resources out there to help you navigate this process. Financial websites, investment publications, even your own brokerage firm can provide valuable insights and research tools.
That's good to know. So it's not like we're just thrown into the deep end and expected to figure it all out on our own.
Not at all. You've got support.
Okay, before we move on, I want to circle back to currency risk for a minute. It seems like that's a unique challenge with international investing. So how can we manage or mitigate that risk?
Well, one approach is to diversify across multiple currencies.
Okay.
By investing in ETFs that hold companies based in different countries, you can reduce your exposure to fluctuations in any single currency.
So spreading our investments across different currencies can help buffer against those risks.
Exactly. It's like hedging your bets.
Are there any other strategies we can use?
Some investors use currency hedging techniques to try to minimize their exposure to exchange rate changes.
How does that work?
It involves using financial instruments like futures contracts or options to lock in specific exchange rates.
That sounds pretty complicated. Is that something that regular investors typically do, or is it more for institutional investors?
Currency hedging can be complex, and it usually comes with extra costs. It's not something I'd recommend for everyone, but if you're really concerned about currency risk and have a large portfolio, it might be something to discuss with a financial advisor.
So for most individual investors, diversifying across multiple currencies is probably the more practical approach.
Yeah, I'd say so. The main goal is to create a portfolio that aligns with your risk tolerance and long-term investment goals.
This discussion about international dividend ETFs has been really helpful. You've given us a lot to think about, from the benefits of global diversification to the complexities of currency risk and the importance of aligning our investments with our individual needs.
It's been great exploring these topics with you, and while we've covered some of the key things to consider, there's always more to learn.
That's true. Investing is a constant learning process.
Exactly. And as we wrap up the segment on international dividend ETFs, I encourage you to keep those principles in mind. Embrace the opportunities that global markets offer, but be thoughtful and informed in your approach.
Excellent advice. And to our listeners, stay tuned for part 3 of this deep dive, where we'll bring everything together and look at some specific examples of international dividend ETFs that might be worth adding to your portfolio.
Welcome back to our deep dive into dividend ETFs. We've talked about the power of dividend growth in the U.S. market and the ins and outs of international dividend investing.
Yeah, it's been a lot to take in, but really helpful.
Definitely a lot to consider. But remember, it's all about finding that sweet spot.
That sweet spot.
Yeah, between growth, stability, and diversification.
Okay, right. Finding that balance.
Exactly. And making sure your choices align with your own goals, risk tolerance, and time horizon.
You've really stressed the importance of making informed decisions that fit our individual needs. So as we wrap up this deep dive, do you have any final tips or insights for us?
Well, I think one of the biggest takeaways is to always keep learning.
Oh, okay.
The world of investing is always changing, so staying updated on market trends, economic conditions, and new opportunities is key.
So even after we've put together our portfolios, it's not just a matter of setting it and forgetting it.
Right. It's an ongoing process. You need to regularly review your portfolio, assess how it's doing, and make adjustments as needed to stay on track with your goals and risk tolerance.
So basically, stay engaged. Don't just assume everything will always go smoothly.
Exactly. And don't be afraid to seek out more information or talk to a financial advisor if you need help.
That makes sense. It's like anything else in life, really. The more you know, the better equipped you are to make good decisions.
Exactly. And remember, the best investment you can make is in your own financial education.
This has been such an insightful conversation. Thank you so much for sharing your expertise with us.
It's been my pleasure. I hope this deep dive has given you the confidence and knowledge to approach dividend investing strategically.
And to our listeners, we encourage you to keep exploring the world of dividend ETFs. Remember, building a successful portfolio takes time and research. It's a marathon, not a sprint.
Well said, and never stop learning.
That's a wrap on another deep dive. Until next time, happy investing.